Hi everyone, welcome to Investing with Shakib. So I'm starting a video series about how to generate weekly income from option trading. It's going to have about 5 videos. Each video will cover one single option trading strategy that you can use to generate income weekly. We're going to start with the put credit spread. So this video is going to be really fun. If you're new to option trading or you want to get really good at controlling your trades, this video series is going to be great for you because the way I'm going to structure the videos, I'm going to first explain the strategy in really basic, like layman terms. Then I'm going to show you an example where the numbers are really nice and pretty, like the stock is at $100, credits are at $100. What happens, right? And then I'm going to show you a real trade, so which is really important because if you're starting out, it's really helpful to see real trades. In terms of opening the trade and then also closing the trade to lock in your profit. So it's going to be a lot of fun through the series. So make sure you subscribe and stay tuned for all the upcoming videos. Okay, I'm going to have the video broken out by chapters based on the structure I just mentioned. So don't skip, or if you feel like you know something, feel free to move to the next section. Okay, so let's get started. Today's video topic is put credit spread, also known as bull put spread. They mean the same thing. I'm going to use them interchangeably. So if you hear me say one or the other, it's the same thing. Here's a really simple way to explain a put credit spread. Let's say there's a stock that's trading at $100 and I think it's a really good stock. It has a lot of potential for growth. In fact, in the next 1 month, this stock will probably not see a price decline and fall to something like $80. So I open a put credit spread. So going forward, every day the stock stays above $80, I'm going to make money. Here's a basic example of a put credit spread trade. There's a stock that's trading at $100. I don't think it's going to fall down to $80 in the next 1 month or so. So I'm going to open a put credit spread. I'm going to sell a put at the strike price of 80, and I'm going to also buy a put at the strike price of 75. The one I'm selling has the higher strike price, so it costs more than the one I'm buying. So there's the net credit, and the net credit is $100. And since the strike width difference between 80 and 75 is 5 times 100, $500 will be my collateral. Okay, so this spread, the value of the spread when I open the trade by selling the spread is $100. It has about a month till expiration. After opening the trade, every day the stock price stays above $80, the value of the spread will decline from 100 to lower every day. So let's say day 10, the stock price is still sitting at 100, or maybe it even shot up higher. What is going to happen is the spread's value from 100 will decline to, let's say, for example, it became half. Why? Because it's just not happening. It's not falling. So at that point, what I can do is purchase the spread back at $50. So what that'll do is I open the spread by selling it at $100. I can purchase it back when the spread value declined at $50. So 100 minus 50 is 50. That is my profit, and the trade is done. And I can do this over and over every week on quality stocks. So in a nutshell, when you're on the sell side, like a put credit spread, you open the spread by selling it. And your goal is to buy it back to close the trade at a cheaper price. Whatever you get to keep, that is your profit. So now let's look at a real trade that I recently closed on NVDA, and it'll be a good one. All right, so this is a bull put spread that I'm about to close. I wanted to show this trade as an example. So I opened this trade on December 20th with expiration date of January 12th. At the time, I decided that I don't think NVIDIA will fall down to 475 or below. So I sold the put 475 and I bought the 470 to create my bull put spread. This is my downside protection. So as you can see, over let's say a month or a week, however long I've been holding it, from 2 weeks to a month, because I was right, as NVIDIA is right now trading at 510, this the value of this credit spread has been declining steadily, especially between the last 3 days, because NVDA started going up compared to the last 2 days, last 2 weeks from the trading days. So it is right now, out of the 127, we have already collected 113. When I say collected, right now the value declined from 127 to 15 cents. So if I close this trade now, I will be locking in $113 profit. So I sold the bull put spread to open the trade at 127. Right now I will close the trade by buying it back at somewhere around this price. So let's do it. Limit price, yeah, let's try 15. As you can see, they're both sell to close, buy to close. The one I bought to open is now sell to close. The one I sold to open is now buy to close. All right, let's do it. Filled. That's it. That's essentially all you have to do to close a bull put credit spread. I have another spread that I could close. Let's try this one. This is supposed to expire on January 26th. It's already sitting at 62% if I lock it in right now, so I don't mind. Let's do it. I just want to get it closed, so let's just try 0.45. So essentially, I sold it for 117. I am willing to close it by buying it back at 0.45. Filled. All right, so let's get this one closed. This is the one that was January 19. Opened it at 140. Right now it's at 40. I think 0.41 will do, as it's telling you. Let's close it to lock in the profit of $100. There we go, filled. So I just closed. I just showed you an example of 3 credit spreads that I just successfully closed for some around $200 or $300 profit. So it's that easy. I've spent less than 15 minutes to do all 3 of these trades, and this is what I do, where I just go to let's say I go to NVDA and I just look into, okay, I'll open one for February 2, February 9, February 16, whatever, and pick really safe strike prices that will not be tested if there is a down day in the future. All right, so to close it off, I'm going to show you how to open a put credit spread using NVIDIA. It's a pretty good stock for this year, considering all the AI growth ahead of us. So let me show you. So we're going to go to the option chain. Today is, let's say, January 19th. We're looking at let's look ahead maybe a month or so. All right, let's look at February 16th. So right now the NVIDIA stock is trading somewhere around 547. My opinion, I think there's a possibility of pulling it back. Now, how far can it pull back, right? You want to be safe. I don't like to be greedy about put credit spread. It's supposed to be a very safe trade. So I'm gonna go on a limb and let's say I don't think this stock is gonna fall below 500 in the next 1 month or so. So for example's sake, I'm gonna form a trade. I'm gonna switch over to put. I'm going to go to sell. Right now the stock is at 547. We're gonna go to 500 and we're gonna have it on sell. So we're gonna sell it. So it's $6.10 credit. Now we're gonna buy the downside, $4.95. There we go. Robinhood will automatically detect that it's a put credit spread, and the net credit is 75, and the collateral will be 500. It should let us know somewhere in here. As you can see, collateral is 500. And then once I open this one, I'm going to go to February 23rd, open another one and another one. So as the days go by, every week I will have an option that is expiring and I can lock it in for profit. Okay, so you made it to the end of the video. If you have any questions, please let me know. I will respond to every single comment. I will also leave a few tools that you can use to learn how to set up put credit spreads like Google Sheet and etc. It's all free. Just feel free to make yourself a copy. Our next video topic will be bear call spread, or it's also known as call credit spread. Anyway, that is it. If you enjoyed the video, don't forget to subscribe and give it a thumbs up. As always, thanks for watching.